Okay, thank you, Shukji, for all the support. Hello, everyone. Good morning. Uh, a very warm welcome to everybody for today's session on India's 102 share-based payments. I hope your studies are going good and you must be actively doing the revisions of all the key concepts before coming to these revisionary classes. So let's start. Uh, I just wanted to ensure that everybody has joined in. So maybe I can wait for a minute and then probably I can start. Okay. So I hope whoever was in the process of joining must have joined by now. So let's start with the uh, India's 102. So uh, we will do quick revision of the key concepts which we have studied in our main live classes, and thereafter we will start doing some practical questions. So that's the objective of today's session. Okay. So what do you mean by the share-based payment arrangement? So first of all, because the standard is revolving around to tell us the accounting of how the share-based payments needs to be accounted for, right? So for that, first of all, we need to understand what share-based payment arrangement means actually, right? Then only we will be able to understand what is the scope of the standard and which all types of transactions are covered or governed by this standard, right? So what do you mean by the share-based payment arrangement? So share-based payment arrangement, as the name suggests, is an arrangement whereby there are two parties. Party one is the entity on which we are talking about, applying the standard, right? So this is the entity, party one, right? So this entity is doing, that entering into the contract with another party, right? So the party two is the another party who either could be the employees of the company or could be third party, right? So party two can be either the employees or could be a third party, simple raw material supplier or vendor, or any supplier of the property, plant and equipment or fixed assets. So like that, right? Now, what is the arrangement between these two parties? So entity is entitled to receive the goods or services from the party two, right? So party one is entitled to receive the goods and services from the party two, and party two is entitled to receive the payment either in the shares of the entity or in cash basis on the value of the shares, right? So that's what the share based payment arrangement means. So here the payment to the party two, that is the obligation towards party two, is either getting discharged by paying in number of shares of the party one or by paying cash equivalent to some number of shares, right? So that's why it is called share based payment arrangement, right? So payment or obligation to party two is getting discharged basis on the shares of the party one. So that's what the share based payment arrangement is, right? Now here what is happening? So party one is receiving the goods or services, right? Goods oblique services from party two, and party two is entitled to either the equity shares or the cash equivalent to the value of a number of equity shares, right? So that's why this is called payment basis on the shares. That's why the name is share based payment arrangement, right? Now there are some certain conditions which needs to be complied right, in order this transaction to occur, and the obligation towards party to getting discharged. So those conditions are called vesting conditions, right? So we will talk about these conditions as well, what those conditions are, and what is the importance of these conditions, right, in this whole arrangement. So first of all, we will understand what is the scope. Now, as we have understood the share based payment arrangement, so it is either with the employees or other than employees, right? So standard applies for any grants of shares to employees, right? So you must have seen that some companies, offer grant to employees, right? ESOP, employee stock option plans, right? ESOS, employee stock option schemes, right? So all these types of plans which entitles employees to receive some number of shares, provided they are complying with certain conditions, for example staying with the company for next 3 years, right? So this is how the companies used to motivate their employees to stay with the company for the longer period, right? Because if employees know that if they continue with the company for next 3 years or 5 years, as the case may be, they will be entitled to receive some number of equity shares of the company, right? So this is how the employees will stay back with the company for a longer period, and companies motivate their employees by these plans. Now these are called ESOP plans, ESOP schemes, right? Then grant to non-employees, the people who are not employees of the company, they are also receiving the number of shares, some number of shares from the company. For example, there could be legal advisors, financial advisors, or any other consultants, suppliers of the raw materials, suppliers of the fixed assets, or any other suppliers, by whatever nature of service or goods they are supplying to the company. So if they agree with the company to receive the payment towards their goods and services in the form of shares or in the form of cash, determined basis on the number of shares value, then those transactions are also covered within the standard, right? Employee share purchase plans, like I spoke about, ESOS, employee stock option schemes, and there are certain share based payments which are settled by the entity or an external shareholder of the same group. So sometimes it happens that companies, instead of discharging the obligations themselves, their holding or subsidiary company within the same group can discharge those obligations. So even in that case, these transactions are covered within the scope of the standard, right? So that's the broader scope of the standard, and there are certain exclusions. So this standard does not apply to the shareholders in their capacity as such. In their capacity as such, what does this mean? So if the company is issuing initial public offer, right? So investors are subscribing to the IPO of the company. So this is not the share based payment, right? If the company is issuing bonus shares, that is not the share based payments, because these shares are being issued to whom? The shareholders, right? And shareholders are not supplying any goods or services to the company. They are actually getting the shares by virtue of being the owners or the shareholders of the company, right? So any transactions with the owners of the company or the shareholders of the company is outside the scope of this standard, right? Then shares issued in business combination, that is also outside the scope of this standard, because there is a specific standard Ind AS 103 which talks about the accounting for that, right? How the purchase consideration is being discharged, right? And the transactions which are within the scope of Ind AS 32 and Ind AS 109, for example rights issue, bonus issue, all these financial instruments, right? Or any transactions, any share buyback. So all these transactions are well governed by our financial instruments, because they are specifically dealt with Ind AS 109, right? So those are also out of the scope of this standard, right? Any questions until now? Anybody wants to ask anything? Okay. Now, the key important concept to understand this standard better is, we understand the basic terms, right? And the timelines, how and when those important, dates are uh, put up on this timeline. So this is the pictorial presentation. So basically, this is the date which we call grant date, right? So this is the date which we call grant date. What do you mean by the grant date? Grant date is the date at which the entity and the counterparty, either the employees or the non-employees who are supplying the goods or services to the company, right? So party two, counterparty means party two. Party one is the entity for which we are applying this standard, and party two is the counterparty, right? So grant date is the date at which the entity, that is the party one, and the counterparty, that is the party two, have a shared understanding of the terms and conditions of the arrangement, right? So what do you mean by the shared understanding of the terms and conditions? So shared understanding of the terms and conditions means that the what party one is offering is being understood and accepted by party two, right? So both the parties agree to the terms and conditions of the arrangement, right? So party one says that you are going to supply these goods by these dates to me, and party two says, okay, I will be supplying. I understand what is the configuration of the goods and services I need to provide over the scheduled delivery dates. I agree that I will provide that. So that is the terms and conditions agreed between the two parties. And the party one says, I will be paying you by 500 shares of mine, right, of my company instead of the cash. And party two agrees, okay, I am happy to receive the 500 shares of yours companies in lieu of the goods and services which I am supplying to you, right? So that's the arrangement, or that's the agreement between the two parties. Both the parties understood all the terms and conditions and signed off, right? So that's the date on which this agreement took place is called the grant date, right? So on this date, the shares are being agreed upon to grant to the party two. Then suppose if this period is for 3 years, right? So at the end of the third period, vesting date. So this is the date when these shares will actually vest to the party two, because the party two has agreed to provide those services over next 3 years, and on year three the shares are getting vested. That is, they are entitled to be received by the party two from the party one, right? So vesting date is the date when vesting conditions for the entitlement are satisfied. That is, whatever the goods and services were agreed to be supplied are supplied, and the party one is satisfied with those goods and services, and hence they are entitled, or they are now obliged to offer the agreed number of shares to the party two, right? So this setup either could be imagined from the perspective of the employees who are entitled to receive the shares from the company if they stay with the company for next 3 years. So once the employees stay with the company for the next 3 years, they will be entitled. And when they become entitled, that is called the vesting date. That is, the shares are being earned by the employees by complying with the vesting condition, which was to stay with the company for 3 years, right? Now, what is called the vesting period? So vesting period is the period from the grant date till the vesting date, right? So this period is called the vesting period. And why we are talking about this period, how we are concerned about this? Because within this vesting period, there are 3 years which are falling, right? And anyway, for all the 3 years, we need to account for this transactions, expense and liability, and we need to come up with the financial statements for these 3 years for the company, right? So for the year one, how much expense the company needs to record in its books of accounts by virtue of this share-based payment arrangement, that we need to calculate, right? So that needs to be calculated and recorded. So that's why vesting period is important. What is the vesting period? The period during which all the specified vesting conditions are to be satisfied, right? So this is the period under which vesting conditions needs to be satisfied, right? And this is the exercise date. What is the exercise date? The date when the awards are exercised by the third party or the party two, be it employee or be it a non-employee. So once the shares are vested, they are exercised, right? So exercise date is the date when the party two actually ask for the shares to be credited into their demat accounts, right? So that is called the exercise date. Now, what is the significance of the grant date? Why we are so much concerned? What's the grant date? So grant date significance can be understood because by this, because this is the date when actually the agreement is taking place. Both the parties are agreeing to the arrangement or having the shared understanding of the terms and conditions. Once this condition is met, then only we can say that yes, there is a share based payment agreement between the two parties, right? And on the grant date itself, the entity confers on the counterparty the right to cash or other equity instruments of the entity on the meeting of the vesting conditions. So, party one, that is the company, agrees to provide cash equivalent to the value of number of shares or the shares as the case may be to the other party provided the vesting conditions are met. And if the agreement is subject to an approval process, the grant date shall be the date when the approval is obtained, right? Because post approval only, this agreement comes into effect. For example, if a particular arrangement between the entity and the third party requires the shareholders approval, then if either the EGM is conducted to take that approval or in the AGM that approval is taken, then when the AGM or EGM is conducted for that very approval, that date will become the grant date in that case, right? So grant date is the date when two parties have actually understood the terms and conditions and agreed upon a share based payment arrangement, right? Okay. Now, once the agreement has entered into between the two parties, we need to come up with the measurement, right? Now, the question comes on which date this measurement needs to take place. So, standard says the measurement has to take place on a measurement date. And what that date would be? The date at which the fair value of the equity instruments granted is measured for the purpose of Ind AS 102, right? So that date will be regarded as the measurement date. Now, for the transactions with employees, the grant date will be the measurement date. And for the parties other than employees, the measurement date is the date when the entity obtains goods or services from the other party, right? So if it is related to the goods, then the goods are received from the other party. And if it is related to the services, then those services are rendered by the other party. So that date becomes the date on which the fair value of the shares will be measured, which will be given or offered by party one to the party two, right? So what's the thumb rule here? So the thumb rule is if the transaction is happening with the employees, that is employees are providing their services by coming to the office on a daily basis, so there is no specific date on which the employees deliver the services. So that's why standard says the grant date is equivalent to the measurement date, right? So on the date when the arrangement took place between the entity and the employees, that date itself will become the measurement date. But for the purpose of measuring the fair value of the equity shares with the party other than employee, the standard says the date measurement date should be the date on which those goods are received by the entity or the services are rendered by the party two to the company or entity or the party one, right? Now, what are the types of conditions which you must have, seen in these arrangements? So conditions are of two types. Either they are vesting conditions or they are non-vesting conditions, right? So what is the vesting conditions? So we are concerned about vesting conditions only. So because the conditions which are non-vesting, they are of no use, they are irrelevant for our accounting purposes, right? So vesting conditions are the conditions that determines whether the entity, that is the party one or party two, whether the entity is entitled to receive the services and that entitle the counterparty to receive the cash or other assets or equity instruments of the entity under the share based payment arrangement, right? So what's the standard is saying? Vesting conditions are those conditions which actually determines whether the third party is entitled to receive the payment either in cash or in shares from the entity one by meeting the conditions, right? So those are called vesting conditions. Now, vesting conditions can again be of two types. One is the service condition and the another is the performance condition, right? So what do you mean by the service condition? So service condition is the condition that is related to providing services for a specified period, right? So service condition means where the counterparty, that is the third party, is expected to complete a specified period of service during which the service are provided to the entity. If the counterparty, regardless of the reason, ceases to provide the services during the vesting period, it has failed to satisfy the condition. So suppose if there was an arrangement between the company and its employees that employees need to stay back with the company for a period of 3 years, right? And if the employee leaves after 2.5 years, then what do you think? Whether that employee will be entitled to any shares or not? What do you think?
No, sir, not entitled.
Right. So service condition is the condition related to the period, right? So if the employees are entitled to receive the shares once they complete 3 years, so they have to complete 3 years only, right? Unless and until they complete the 3 years, they will not be entitled any shares, right? So vesting conditions are not satisfied, hence no vesting will happen, right? No share entitlement will happen to that particular employee, right? Who is leaving the company prior to completion of the 3 years, right? So that is called the service condition. And what is the performance condition? So performance condition is over and above the service condition, which requires a specific performance to be met, right? For example, in most of the companies, there are some KRAs happen annually, KRAs, and there are the ratings defined on a scale of 1 to 5 for all the employees, right? And if the company says that the employees which are rated 5, which is the topmost rating, right? So, or employees which are rated 4 will be entitled to the shares, right? And the rating 1 is an immediate, exit from the company because you are not at all performing as per the expectations of the company. Rating 2, maybe, the employees will be given a warning from the HR. And rating 3, you are just meeting certain expectations, right? So only the employees who are rated 4 and 5, either the rated 4 or the rated 5, in next 3 years will be entitled to these shares, right? So this is called the performance condition over and above the service condition. So service condition is to stay with the company for next 3 years, and the performance condition is that employees are actually performing their duties as expected by the company. And hence, on a scale of 1 to 5, they are rated for all the 3 years, either at 4 or at 5, right? So once both the conditions are met, that is the 3 years completion with the company and the rating in all the 3 years, either 4 or 5, then only the employees will be entitled. Now, my question to you is, if a employee stays with the company for next 3 years, but in any of the 3 years, he is rated at 3, and in remaining 2 years, he is rated at 4 or 5. What do you think? The employee will be entitled to the shares or not?
No, sir.
Why?
Sir, in all the 3 years, he should meet that performance condition, sir, of 4, getting 4 or 5.
Correct. So, basis on the terms and conditions of the arrangement of the ESOP plan, employee stock option plan, there were two conditions. One was the service condition, that is to stay with the company for the next 3 years, and one was the performance conditions, that you must be rated either at 4 or at 5 throughout the 3 year annual appraisal cycles, right? So, if any employee is meeting both these conditions, the service condition as well as performance condition, then only he will be entitled to receive the shares from the company, otherwise not. So what we have learned from this, that service condition as well as performance conditions both are crucial to determine the eligibility of the entitlement of the shares to the employees, right? So we cannot ignore any. So if the employee was rated, say 4 or 5, but did not complete 3 years by any chance, then also he will not receive the shares. Or if the employee has completed the 3 years, but by any chance in any of the year he was not rated 4 or 5, conditions are vesting conditions because they determines the eligibility of the employee to receive the shares, right? Any questions on this? Okay. Now, performance conditions can again be of two types: market condition and the non-market condition, non-market related conditions. So, what is the market condition? Market condition means which are the conditions which cast, the eligibility of entitlement of shares to the third party basis on the share price performance of the company, right? So, in market related condition, the exercisability of the equity instrument or vesting of the equity instrument depends upon the market price of the equity instrument. For example, suppose Tata Motors comes up with a plan that all the employees will be awarded 1,000 shares at the end of the 3 years, provided they stay back with the company for next 3 years. And if the Tata Motors share price goes beyond rupees 1,000 per share in the market, right? At the end of the third year, right? Now, because whether the Tata Motors share price will reach the 1,000 rupees mark or not in the 3 years is neither in the control of the company nor in the control of the shareholders or the employees or any third party, right? So, how this condition can be, complied with by putting certain efforts by the third party, right? So because it is all beyond the control of those employees who are working for Tata Motors, diligently, right? So standard says market related conditions which are specific to the share price performance of the company is of no use for our purposes, and we will simply disregard if there are any such conditions in the arrangement, right? So we will simply ignore those conditions. So any condition which is there in the share based payment arrangement related to the share price performance of the company, so that will be disregarded, right? So we will not consider that for any purposes of this standard. Now, non market related condition, what that could be? So this could be, for example, company says that 1,000 shares will be awarded to all the employees provided they stay back with the company for next 3 years. Plus, if the company is able to generate, sales beyond 5,000 crores, right, by the end of the third year, right? Now, what do you think? Whether this condition uh, is should be covered or should also be ignored, because if employees work hard, then probably that milestone can be achieved by the company, yes or no?
Yes, sir.
So that
So
is
one more
also,
question.
so that is also one of the performance condition. For example, if the company, constructs a sort plan for their marketing team, that if they market the cars in a better way and they are able to increase the sales of the company, they will be receiving some shares. So now here the reward is basis on the performance of the company, which is in turn is the performance of its marketing team, how they are creating good advertisements which are leaving a good impression of the company's products on the minds of the consumers, right? How they are able to change the taste or behaviors of the consumer towards the company's products, right? How they are doing the marketing so that consumers who were about to buy the cars from other suppliers and they actually buy the cars from the company. So all that effort is within the hands of the marketing team, right? So they can put more and more efforts to drive more sales, right? So this is regarded as one of the performance condition. But if the Tata Motor says if my share price reaches 1,000 mark at the end of the third year, then that will be a market condition, right? So performance conditions can be of two types, which is the performance of the share price of the company and which is the performance of the KPIs of the company. For example, higher sales, higher profits, higher margins, right? New markets which we can enter into, right? Or we can increase the share in the market, overall market. For example, Tata Motors holds say 20% shares of all the domestic sales, and Tata Motors says that yes, if our shares increase from 20% to 25% in the market by the end of the third year, all the employees will be awarded 1,000 shares. So that is again a performance condition, non-market. So market means share price and non-market means other than the share price performance KPIs. Yes, please go ahead with your question.
So means actually I was searching. Abhi, I had not read this. Ki there is a condition only 3 years vesting period condition is not specified by the standard. Now it is specified by the company as per the policy of their internal things.
Correct, correct, correct. So standard is not saying 3 years. So I am taking the example of 3 years. It could be 2 years, it
Sure,
could be
sir.
1 year, it could be 3 months, it could be 6 months, it could be 5 years, it could be 10 years, any period, as per the terms of the arrangement between the company and the employees or the third party. So 3 years is not defined by standard, of course. Clear?
Yes, sir. Thank you.
Okay. So let's do these quick examples. Employee will get 100 shares each if they remain in employment for next 3 years. So maybe I can call it as 5 years to avoid your confusion. For next 5 years. So this is the condition type of service condition, correct? Then employees will get 100 shares each if the company's share price reaches INR 1000 per share on the NSE next 2 years. So this is the market condition and we will simply ignore. Correct? Employees will get 100 shares each if they remain in employment for next 2 years and the company's EBITDA rise to 10 crore. So this is a service condition and the non-market performance condition, right? Because we are not talking about the share price, we are talking about the EBITDA of the company, earning before interest, tax, depreciation, and amortization to rise, right? Company announces 100 shares to each employee as a gift on its 10th anniversary celebration function. So there are no vesting conditions because on the day of the annual celebration or 10th anniversary celebration, company simply announced that all the existing employees will be awarded 100 shares each. So it means the employees who are already there on the payroll on that very date are entitled. So there are no further vesting conditions because there is no condition for employees to stay back with the company for some period, right? So it is a simple announcement on that very date. So there are no vesting conditions at all. It is a gift. Company gives 1,000 shares to a director for non-competing with the company for next 3 years after he has left the company. Again, no vesting conditions because this director has already left the company, started doing its own startup business, and the company agreed that I will give you the 1,000 shares if you don't enter into the business which is the company's business. So the director agreed, signed the agreement, and got the 1,000 shares. So there are no vesting conditions, right? So these are the quick examples of vesting conditions, non-vesting conditions. Reload feature and reload option. You must have heard this concept as well. So what is the reload feature? A feature that provides an automatic grant of additional share options whenever the option holder exercises previously granted options using the entity shares rather than the cash to satisfy the exercise price. Sometimes it happens that company offers 100 shares to the employee and the employee exercised. Company said the exercise price is 10 rupees while the fair value of the shares is 100 rupees. So all in all 90 rupees is the benefit which the employee will be getting on that. So employee said, okay, what I will do, I will, instead of paying you 10 rupees in cash, can I give you the shares back of equivalent value of the exercise price? Company agreed. And you know again, the number of shares the company is getting from the shareholder in lieu of the exercise price value will be reloaded to the employees plan. A new share option granted when the share is used to satisfy the exercise price of the previous share option, right? So in any of the previous plan, employee exercised to pay the exercise price by crediting by returning the number of shares equivalent to that value, then he also gets the reload option right in the next plan. What is the treatment of the reload feature? So for options with a reload feature, the reload feature shall not be taken into account when estimating the fair value of the options granted at the measurement date. Instead, a reload option shall be accounted for as the new option grant if and when the reload option is subsequently granted. So basically what is happening over here, there are some additional shares being offered to the employee, right? And those additional shares are to be treated as a fresh new plan for the employee from the company, right? So that again will be accounted for as the existing plan, right? So we will not make any adjustments to the existing plan or the fair value, right? Granted fair value. What we will do, we will treat these additional shares which are getting reloaded to the employee, over the vesting period, if any, for on which these reloaded shares will be entitled. So this is again treated as a separate plan only, right? So this is not going to affect your accounting under your existing plan. Now, there are certain types of the share-based payment arrangements. What are those? Number one,
Sir,
equity settled. Yes, please.
sir, can you explain that reload feature again, sir, with an example if possible?
So reload feature basically is nothing but additional shares which will be given to employee if employee unit discharges the obligation of the exercise price by paying in the number of shares, right? So equivalent number of shares are reloaded if the employee meets certain additional conditions which are there, right? So if it meets, then reload shares will again be credited to the employee over that period, right? So it is nothing but like a separate share based payment plan only. So the existing plan where the employee was supposed to pay 10 rupees as the exercise price for 100 shares. So all in all 1000 rupees. So instead of paying that 1000 rupees in cash, employee said, okay, you can, take the shares back of equivalent to the 1000 rupees, right? And those number of shares are entitled back to the employee provided there are certain additional conditions satisfied. If the employee satisfies, those shares will again be credited to the employee, right? So this is called the reload feature.
So that means for the shares which he is paying, he has to satisfy the conditions, sir.
No, no, no. So under the existing plan, instead of paying the exercise price in cash, he is discharging that by getting lesser number of shares, right? Suppose he was entitled 1000 shares. Now he says, I'm okay to receive 900 shares. You can deduct the 100 shares equivalent to the exercise price, which I otherwise would pay in cash, right? Now those 100 shares will again be reloaded to him, right? Basis on certain additional conditions. Might be, say, if he stays back with the company for next 1 year, one more year, he will again get those 100 shares, right? Then if he continues with the company for 1 year, he will be entitled to receive those 100 shares again. So that is treated as a separate plan only rather than making any adjustments to the existing plan, right? So that's what the standard is saying. So reload is a separate plan only, basically.
Yes, sir, got it, sir. Thank you.
Now, what are the types of the share-based payment arrangements? So one is the equity settled, where the third party is receiving the shares from the company. One is the cash settled, where the third party is receiving the cash or other financial asset instead of the shares, but the value of the cash will be determined basis on the shares fair value, right? And the third could be share-based payment alternative with the cash, right? So where the third party can choose either to receive the shares or to receive the cash, and this is in the hands of the third party, right? So these are the three arrangements. So I can call it as equity settled. First one is equity settled, second one is cash settled, and third one is hybrid. Okay, maybe, right? Just for easy remembrance, right? Otherwise, the name is the share-based payment transaction with the cash alternative, where the cash can also be demanded instead of shares, right? Now, when we do the accounting, how we are going to record the journal entries, what account we will be debiting and what account will be crediting. So, suppose we are recognizing the share-based payment transactions, then the journal entry would be debit the expense, right? At the end of the day, it is the expense for the company because they will be paying some shares to the employees or the third party. Yes or no? So this is the
Yes,
expense
sir.
in the books of the company. So we will debit the expense, right? And what we will do the credit. So if the arrangement is getting settled in equity, that is the equity settled, then we will credit the equity by increasing the equity, because at the end of the day what is happening, equity shares are being issued, so our equity share capital will increase. And if we are not giving the equity shares but we are offering cash basis on the value of the shares, then what we will do, we will record simple a liability, right? So we will increase our liability because now we are not going to issue shares, but we are going to issue or pay in cash. So whatever amount of cash we need to pay will result into a increase in liability on our balance sheet, right? So expense debit to share equity option account, which is a notional account, right? And which will be debited once the shares are issued. So that I can use as of now. Or if it is settled in cash, then the liability account. So the entry would be expense account debit, right? To ESOP account or to liability account, right? So if it is to be discharged in the equity shares, I can use any notional account, or if it is to be discharged in the liability, I will simply record the liability. Once I discharge, so what I will do, ESOP account debit to equity share capital, yes or no? I will issue the equity shares, which will increase my equity share capital. And if it is the liability which was recorded, then liability account debit to bank account. Yes or no? Clear?
Yes, sir.
Okay. Now, on the equity settled transactions, how we are going to measure, when we are going to measure, and what would be the recognition date. So measurement principle is the fair value of the equity instruments granted, right? So whatever the equity shares, suppose if I'm granting 1,000 shares, then what would be the value? 1,000 shares into their per share fair value, right? And which date? Of the grant date, right? The date on which the agreement has taken place between the entity and the third party, right? And the date on which the goods and services have been measured. So this is the recognition date. Now, there are two situations. Situation number one, when the transaction is with the employees, and the situation number two, when the transaction is with the third parties, that is other than employees. So in case of the transaction with employees, right? So we will determine the fair value on the grant date and record on the grant date. And with the third parties, for example, raw material supplier, fixed assets, or machinery supplier, then fair value of the goods and services if it can be estimated reliably, right? Because at the end of the day, what we are getting from the third party, the goods or services, the machine, the fixed assets, right? So there is a fair value of those goods and services. So at that fair value, we will be recording. If that is not estimated reliably, then the fair value as on the date on which the goods or services are received of the equity shares, right? And the date on which the goods or services are received is becoming the date on which the record accounting entry will be recorded, right? Now, cash settled. Equity settled, we understood that equity shares will be given, right? If it is being given to employees, then grant date fair value. If it is being given to third party, then the date on which the goods or services are received, the fair value of those goods and services. If goods and services fair value is not determinable, the fair value of the equity shares. But if it is being settled in cash, so there is no equity share in question to be issued, right? Now, what we will do? So when the transaction is getting settled in cash, it means it is a liability, right? Because we have to pay cash instead of the equity shares, right? And liability needs to be reinstated at each reporting date, right? You must have learned this in your regular classes. So initial measurement will happen at the fair value of the liability on the date when the goods or services are received, or on the grant date in case it is with the employee. And then at each reporting date, at the end of the each reporting date, the fair value will be reinstated for this liability. For example, at the close of the year, that is 31st March, if the share price fair value changes, the liability will also be reinstated. If the fair value increases, liability will be increased. If the fair value decreases, liability will be decreased. This is how the cash settled transactions will be recorded as a liability. And the third category, hybrid one, the share-based payment transactions with the cash alternative. So in that case, what we have learned so far in our regular lectures, that if it is a cash share-based payment transactions with the cash alternatives, then it provides the counterparty with a choice of the settlement, scenario one, and it provides the entity the choice of the settlement, right? So if the third party has the choice whether they can demand cash or they can demand equity shares, so it means we do not know what they will demand, right? And because we do not know, so as on today's date, this is a compound financial instrument for us, right? For the entity, it is behaving like a compound financial instrument where there could be a debt obligation and there could be a equity component as well, right? So we will do some practicals on this so that you will better understand how these needs to be accounted for and separated. But as of now, we are just simply revising the key concepts what we have learned in our regular classes. So these debt component and equity component needs to be measured, right? So counterparty's right to demand cash and the counterparty's right to demand equity shares, right? So equity component denotes the value of the right equivalent to the equity shares demand, and that component denotes the right of the counterparty to demand the cash, right? Then fair value will be measured separately on the date of the receipt of the goods and services, and fair value is measured separately as the balancing figure. So in Ind AS 109, whenever you were dealing with the hybrid instruments accounting, you must have seen that equity options value is arrived by deducting the fair value of the liability from the total proceeds. Yes or no? So that is called the balancing figure, the equity option, equity component, right? Similarly, here as well, equity component or equity option will be considered as the balancing figure. Now, the debt portion, that is the liability portion, will be treated as the cash settled, right? And the equity portion will be treated as the equity settled, right? So what we have done in this, so in this, because the third party has the right to demand the cash or the equity shares whatever they want, right? So we do not know what actually the transaction will result into and how it will be settled. So for us, on the day one, it is a hybrid financial instrument or compound financial instrument. So we will segregate the debt component and the equity component in this and accordingly account for. Now, in the second situation, when instead of the third party, entity has that right or the right to choose how it is going to discharge. So if entity chooses to discharge in cash, it will be cash settled. If entity chooses to discharge in equity, it will be equity settled. Now in this case, the complexity is not there to segregate the debt and equity component because the right sits with the entity and entity knows what they are going to do, right? So if they know what they are going to do, so they know whether they are planning to settle in cash or they are planning to settle in equity. So if they say we are going to settle in cash, then they will do the cash settled accounting. If they say that we are going to settle in equity, they will do the equity settled accounting, right? So the things are simple when the entity has that choice, and things are little bit complicated when the other party has that choice, right? Because we don't control the choices or the decisions of the third party. So as of now, we don't have clarity what they are going to ask for, right? Now, then you must have learn the concept of modification. So whenever there are any modifications to the existing plan, right? So we categorize those modifications into two categories. Either they are beneficial to the employee, that is, they are resulting either in the higher number of shares or the higher value shares to the employee, or they are non-beneficial, right? So if they are beneficial, then what do you mean? If we are giving more benefits to the employees, then it means more expense on the part of the company. Yes or no? Yes or no?
Yes, sir.
So this, because it is beneficial to the employee as compared to the previous plan, so it is resulting into higher expenses as well, or additional expenses for the company, and hence we will record this prospectively. That is from the date of the modification until the date of the vesting, right? And if it is non-beneficial for the employee, right? So that is the reduction of the number of shares, decrease in the number of shares, decrease in the fair value or whatever, right? Which is resulting into loss to the employee as compared to the previous plan. Then we will simply ignore. We will not do any accounting for this. Clear? So whatever was the original accounting will continue to happen until the vesting happens. So we will not do anything, at least for accounting, under this standard for anything which we have changed to the plan which is non-beneficial to the employee, right? So in case of non-beneficial, company is not incurring any additional expense, and hence no further accounting is required or additional accounting is required. So what was the expense which intended to be recorded over the period of 3 years will continue to be recorded that way only without making any change. Is that clear?
Yes, sir.
Okay. And the last piece, the cancellations and the settlements. So under the cancellations and settlements, you must have studied that cancellations and settlements basically takes place, for any reason. For example, the company simply cancels the plan, right? So the company generally cancels the ESOP plans when they, are entering into any of sort of financial difficulties or any for any reason, right? If the plan is getting cancelled, right, on any date, then what will happen? Because we need to do the accounting for any such cancellations, right? Now, account for these cancellations or settlements as an acceleration of the vesting. What do you mean? Suppose company launched a ESOP plan, say in 2022, and 5 years was the period, right? So when the plan was maturing, 2027, correct? But in 2025, company cancelled the plan. Then suppose the expense for this 5 year plan, which was otherwise will be recorded in the P&L over the period of 5 years. Now, what we will do? We will record the expense which otherwise would be recorded in the year 2026 and 27 in the 25 itself, because the plan is getting cancelled in 25. So whatever is the remaining expense which otherwise would have been recorded in the next year and the next to next year will be recorded now. That is called the acceleration of the vesting. That is, we will say the plan is vested today. So, assuming the plan is vested today, what is the total remaining expense which needs to be recorded? So, that total remaining expense will be recorded today itself, right? So, recognize immediately the amount that would be recognized for the services received over the remainder period of the vesting period, right? So out of the 5 years vesting period, how much vesting period is already completed until now? 3 years, 22 to 23, 23 to 24, and 24 to 25. And what is the remainder period of the vesting period? 25 to 26 and 26 to 27, right? So standard says if the plan is getting cancelled in 2025, then the remainder period, vesting period expense will also be recognized on the date of the cancellation itself. So that's called the acceleration of the expense booking. The expense which otherwise would have been recorded in next 2 years will be recorded now, right? And if there are any payments happening to the employee for these cancellations or settlements, those payments will also be recorded separately, right? So we will do the numericals on this. And if there are any repurchase of the vested equity instruments which are already vested to the employees, then if the employees is giving back those shares to the company and company is paying cash for receiving those shares, right? So for the payment to the employee shall also be accounted for as deduction from the equity, because equity shares are being bought back. So when the equity shares are being bought back from somebody and cancelled, it means my equity share capital which had been issued is now getting reduced? Yes or no? Yes, because I'm receiving my shares back and I'm canceling those shares. It means I am doing a reduction in my equity share capital, right? So that will be treated as a deduction from the equity, right? So once we do the numericals, it will be all clear to all of you. Now, there are certain key differences between the Ind AS and the IGAP. So, what is the corresponding standard in the IGAP? No standard, right? However, there was a guidance note available which talks about intrinsic value. So, guidance note says for any share-based payment transactions to the employees can be measured either on the grant date fair value or on the grant date intrinsic value. That is, the free choice was made available under the Indian GAAP guidance note. But Ind AS 102 says that it can be recorded only on the fair value, right? So intrinsic value accounting is not allowed unless and until someone comes and says that we are not able to measure the fair value of our equity instruments for so and so reason, and they can demonstrate that. In those rare cases only they can migrate from the fair value accounting to the intrinsic value accounting approach, right? Furthermore, the scope of the standard 102 is wider. Standard India's 102 talks about the transactions with the employees as well as with the non-employees, right? But guidance note does not talk about the transaction with the non-employees. They all also only talk about with the employees, right? So that is the key difference between the India's and the IGAP. And certainly, because India's is a detailed standard, it is talking about various types of transactions like the normal vesting, graded vesting, all that. The Indian gap is not very detailed, right? So that's all about. Are there any differences between the India's and the IFRS? No. So whatever is there in the IFRS, we have simply uh, adopted the same without any carve-ins or carve-outs, right? So these are the quick MCQs. So let's try these MCQs quickly before we jump on to our practical questions. So I want your answers either in the chat box or you can unmute yourself and tell me. Company B has approved a bonus plan for its employees as per which the amount of the bonus will depend on the shares price achieved at the end of the year as follows. If the share price is below 10, bonus is 0. If the share price is between 10 to 12, the bonus is 1000. And if the share price is above 12, the bonus will be 1500. Whether the above arrangement is within the scope of Ind AS 102. Yes, it is a equity settled. Yes, it is a cash settled. No, it is not a share-based payment, uh, based payment transaction. And the option D, the company has an accounting policy choice to consider it as a share-based payment transaction under 102 or employee benefit under Ind AS 1019. What do you mean by this? Whether it is a share-based payment transaction covered within the scope or not. That's the MCQ with the four options. And if it is covered, it is a equity settled, it is a cash settled. No, it is not covered. Company has a choice either to account for it under 102 or to account for it under 19. Okay, any answers? A, B, or C, or D? C, others? You can simply use the chat box. C, B, A. Nobody is liking the D. Okay. So C is the correct answer. It is not a share-based payment transaction. Why? Because what's the arrangement? The arrangement is that bonus will be given to the employees basis on the share price performance, right? So bonus will be paid in cash, right? And whether the bonus will be paid or not depends on the share price performance, right? So it is not a share based payment anyway, right? Because first of all, the payment is neither happening in the shares, right? The bonus payment is not neither happening in shares nor at the value equivalent to number of shares, right? That's what I already explained at the beginning of the today's session, right? Now, what is happening over here? There are three scenarios. If the share price is below 10, amount of bonus will be 0. Share price between 10 to 12, amount is 1000, and share price beyond 12, amount will be 1500. So this arrangement is basically a arrangement outside the scope of this standard, because this is not a share based payment, right? This is a payment of cash basis on the price performance rather than the fair value of the number of shares which will be granted, right? Okay, let's do this one. A Limited issues its shares to a law firm as a payment for the legal services. Is this transaction within the scope? Yes, it is a equity settled. Yes, it is a cash settled. No, it is not a share based payment. No, it is not a share based payment transaction. The transaction will be recognized at the fair value. Okay, what are your thoughts? So A is the answer, Saminathan is saying. Others? Correct. So A is the answer here, because what is happening? The legal firm is providing the services and the ABC is issuing the shares to discharge the obligation. Let's try this one. A Limited issues stock appreciation rights SARs to its employees. The SARs requires the company to pay the employees an amount equal to the appreciation in the value of the 1000 shares of its stock over a 2-year period. Is this transaction within the scope of Ind AS 102? Yes, it is equity settled. Yes, it is a cash settled. No, it is not. And the D, the company has the choice. Okay. So yes, it is a cash settled. Why it is not equity settled? Because SARs. SARs are not shares. SARs are stock appreciation rights. That how much the appreciation will be there in the shares value, that delta will be provided in cash. So settlement will happen in cash, right? And how much cash will be paid is decided by fair value of shares, right? So shares will not be discharged, cash will be discharged, but how much cash will be discharged decided by the fair value of the shares. So that is called the SARs, share appreciation rights. And share appreciation rights are always cash settled without any doubt. Okay, because the name itself says appreciation rights. It is not the shares right to shares, it is the right to the appreciation in value of shares, right? Let's try this one. ABC Limited issues the shares options to purchase the company B shares, an unrelated public company, to its employees. Is this transaction within the scope of Ind AS 102? Yes. Equity settled? Yes. Cash settled? No. Not a share-based payment? D. The option to choose either to account for under 102 or 19. Okay, so Lavanya is saying C, Saminathan is saying A, C. Why? Because it is happening under business combination. A Limited is issuing share options to purchase company B shares, right? So business combination transactions are governed by Ind AS 103 and not by 102. We discussed on the slide 1 as a part of the scope discussion of the standard, right? Let's try this one. ABC Limited enters into a forward contract to buy 1000 units of a commodity at a price equal to the 2000 of the ABC's ordinary shares. ABC can settle the contract net but does not intend to do so, nor it has a practice to of doing so. Is this transaction within the scope of Ind AS 102? Yes, because ABC does not have the practice of settling these contracts net and does not intend to settle it net. B. Yes, all commodity contracts involving the issue of shares are covered under 102. No, all commodities contracts involving the issue of shares are excluded from the scope of the 102? No, 102 only covers only those commodity contracts for which the intention is to settle net. Yes. What is the answer? A. Lavanya is saying A. Okay. Others? Samanathan is also saying A. Correct. Perfect. Let's try this one. ABC Limited has granted a right to its employees to receive cash payment equal to the excess of the share price over rupees 20 multiplied by 1000. For example, if the share price is at 30, at the end of the year 3, the employee will receive rupees 20,000. That is 30 minus 20 into 2000. This is subject to the employee continuing in employment for next 3 years. Whether this transaction is uh, within the scope of this standard or classified as cash settled, equity settled, compound, or it is not a share based payment. A, B, C, or D. Okay, so Sachi Esthana is saying D. Others? Lavanya is also saying D. Samanathan is also saying D. And here is the answer. So we are all getting tricked in this question by the institute, right? Now we will carefully study the question. ABC Limited has granted a right to its employees. So first of all, ABC and employees. The transaction is between ABC and employees, right? To receive a cash payment. So they will receive in cash. Clear? Equal to excess of share price over rupees 20 multiplied by 1000, right? So what the company is saying that whatever is the delta between the share price and the 20. So suppose share price minus 20 into May 2000 will be given, right? Provided the employee stays with the company for 3 years. Yes or no? Yes. So at the end of the third year, the fair value of the shares is how much? 30. So 30 minus 20, 10 rupees into my 2000. How much? 20,000, right? Now this 20,000 will be given to the employees at the end of the third year. Now, in this question, the only word missing is 2000 shares. Yes or no? The shares word is missing, but the multiplier is given only. Now, if the shares word is missing, while we have the multiplier, how can we say that this transaction is not the share based payment transaction? Because what is happening over here? The share price of the company minus the 20 rupees, which is fixed. This is the delta. What this delta is? Share appreciation, right? Share appreciation, right? Yes or no? एक तरीके का सार, yes or no? So if this is a share appreciation right into my 2000, 2000 is the number of shares multiplier. So instead of calling it as the number of shares, they have given multiplier only, right? And you are getting tricked or confused and you are saying, no, it is not a share based payment transaction, while it is. And why, if it is a share based payment, it is a cash settled because it is a SARS. Clear? Everybody is clear on this?
Yes, sir.
Perfect. So now let's try on this one. The conditions that determine whether the entity receives the service that entitle the other party to receive the cash or other assets or the equity instruments of the entity under the share-based payment arrangement is known as what? Vesting condition, correct. India's 102 covers share-based payment transactions among group entities. Which of the following statements are true? Transfer of equity instruments of the undertaking's parent entity to the parties that have supplied the goods and services to the undertaking. And statement number B, transfer of equity instruments of another undertaking in the same group as the undertaking to the parties that have supplied goods and services to the undertaking. Both A and B are covered within the scope. None of the A and B are covered within the scope. So A, B, C, or D. Only A is covered, only B is covered, both A and B covered, none of the A and B is covered. So A, B, C, D. Which option is correct? So Learn is saying C, Sachi is saying D, others. Both are covered, no? Why? Transfer of equity instruments of the undertaking's parent company to the parties that have supplied goods to the undertaking. Yes, this is covered. We spoke about this during the scope discussion. And transfer of equity instruments to another undertaking within the same group as the undertaking to the parties that have supplied the goods and services to the undertaking. Right? So if the company is receiving the goods and services and the shares are being discharged by the company of its holding company or by the other company of the company, both the cases are covered, right? So who is discharging the obligation doesn't matter. In whose shares the obligation is being discharged doesn't matter. The only thing matters is that the other party either is employee or the supplier supplying the goods, and they are receiving the shares either of the entity or of its parent, either discharged by the entity or of its parent, right? So that was it on the revision part. Now let's you want to have a break now or you want to have a break later before we start on the questions, practical questions. So maybe let's do a break now. Let's have a quick 10 minutes break, uh, and we will start at 8:25 sharp. Okay. Break started, Ashok ji. in the chat box. Okay, thank you. Okay, so the question number one, on 1st of January 2001, ABC Limited gives options to its KMP, personal employee, to take either the cash equivalent to 1,000 shares or the 1,500 shares. So either they will receive the amount of cash equivalent to the fair value of the 1,000 shares, and if they don't want to receive in cash, they will get 1,500 shares in their demat accounts. The minimum service required is 2 years, and the shares must be taken uh, shares being taken must be kept for next 3 years by those holders, right? So there is a restriction to sell those shares in the market for next 3 years, right? Now, share alternative fair value, that is with restrictions, is given 102 rupees per share. Grant date fair value on 1st of January, that is the plan's grant date 113. Fair value at the end of the year 2001 and at the end of year 2002 are given 120 and 132. The employee exercises their cash option at the end of the year too, right? So in this case, what is happening? Company is giving the right either to ask for cash or to ask for shares, right? And the right is sitting with whom? The employees, that is the directors, not with the company. So in this case, this arrangement is a share based payment arrangement, yes. And it is falling under which category? Equity settled, cash settled, or the third one, where the other party has the right to ask either for cash or for the shares. So this is sitting in the third one. For the third one, because the company does not know whether the other party will ask for shares or will ask for cash, so this is a hybrid compound instrument on day one for the company. Yes or no?
Yes, sir.
Right? Now, in that case, what we have learned or discussed, that we will do the split first of the cash option and the equity option, right? Now, let's do that. So in this case, on 1st of January, which is the grant date, the fair value of the equity alternative is 102, which is given in the question per share. And how much shares will be given to the directors if they exercise was equity option? 1,500. So number of shares 1,500 will be given, and 102 would be the fair value. So how much value comes up? 1,53,000 rupees. And if they ask for cash, then how many shares will be considered for the computation of the amount of cash which will be eventually paid to them? 1,000 shares. So 1,000 shares into my 113, the fair value. So 100 and 1,13,000 would be the fair value of the cash alternative. So the delta between the two would be the equity option fair value, right? 1,53,000 minus 1,13,000, 40,000. So this 40,000 will be the fair value of the equity option, right? So equity alternatives fair value, cash alternatives fair value, and the equity option. So these calculations we have to do in these scenarios first, right? Now, we will talk about how much expense the company needs to record in year one, that is 2001, and in year two, that is 2002, right? So, cash options expenditure will be 1,000 shares into my 120 rupees into my 1 by 2 is equal to 60,000. So why we have considered 1,000 shares? Because under the cash option, the shares will be used for computation of the value which will be given in cash is 1,000. So 1,000 shares into my 120. Why the 120? Because it is the fair value of one share at the year end, right? Given in the question. And why 1 by 2? Because because the vesting period is 2 years. So we are computing the expense for the year one. So we are pro rata, doing the pro rata calculation. So 1 by 2. So amount comes to 60,000, right? And for the equity option, what would be the amount? 40,000 into my 1 by 2, because we have already calculated this 40,000, right? So 40,000 into my 1 by 2, 20,000. right? So 20,000 will be the equity option expense and 60,000 will be the cash option expense. So the total expense is 80,000 for the year one. Is it clear? Yes, no,
Yes, sir.
right? Now, in year two, how the expense will be calculated? So again, what is my uh, expense for cash option in year two? Again, the 1,000 shares. Yes or no? Yes. Into May. What is the fair value at the end of the year two? 132, right?
Yes, sir. 132.
And into May, what is the pro rata? 2 by 2,
2 by 2.
correct? So 2 by 2 is getting cancelled. So 132 would be the fair value, right? And what is the value of the equity option? Constant, because this is always constant, 40,000, right? And 40,000 into May, 2 by 2, right? So 2 by 2 is getting cancelled. So 40,000, correct? So the total fair value of cash option expense, total value of equity option expense. Now, if we compute the total expense, so for equity option, it will be again 20,000 because out of the total 40,000, 20,000 has already been recognized in year one. So what is the remaining? 20,000, correct? And similarly, the total cash equivalent option expense is 132, out of which 60,000 is already recognized in year one. So what is the balancing? 72,000. So the total of these two would be the 92,000. So 92,000 will be the amount of the expense which will be recorded in year two by the company for these share-based payment plans which they have given to the directors. Now the question comes, what would be the journal entries, right? So for the year one, employee benefit expense account debit, that is P&L account debit in the name of the employee benefit expense. Yes or no?
Yes, sir.
80,000. Two, the share-based payment reserve account, because shares are not being issued as of now because we do not know whether the other party will ask for shares or for cash, right? So what we will do, we are not issuing the shares, but we are creating a reserve. And the name we have given to this is the share-based payment reserve account. 20,000 for the year one. And to share-based payment liability, 60,000, right? So these 20,000, 60,000 are recorded for reserve and the liability. Now the narration will be recognition of the equity option and the cash settlement option expense, right? Then for year two, what would be the entry? Again, the employees a benefit expense account debit, P&L account debit by total amount 92,000 to share-based payment equity reserve 20,000 to share-based payment liability 72,000, right? So this is how the second year expense will be booked. Now, because the third party has asked for cash settlement, so the share-based payment liability account debit to bank or cash. So 132 will be discharged because the total cash discharge obligation is 1,000 shares into my 132. That is the at the fair value of the reporting date of the year two, right? And the remaining 40,000, which we have accumulated in share-based payment reserve account until date, right? 20,000 in year one, 20,000 in year two, will go to the retained earnings because the other party did not ask for shares. So we are not going to issue shares because the shares are not being issued. And this reserve, which was created for issuing shares, if the other party asked for in the future, the other party did not ask. So we will transfer to the retained earnings, right? Clear?
Yes, sir.
Okay, so let me see quickly the chat box. Okay. So let's do the question number two. Tata Industries issued share-based option to one of its key managerial person, which can be exercised either in cash or in equity and has the following feature, right? So again, The company is issuing the share-based options to whom? The key KMPs, key managerial person, and it can either be exercised in cash or can be exercised in equity by those KMPs as and when those options vest, right? What are the features? Number of cash settled shares 74,000. Service condition 3 years. So they need to stay with the company for next 3 years. Option 2, number of equity settled shares of the face value of 100 each 90,000. So either they will receive the cash equivalent to 74,000 shares fair value, or they will receive 90,000 number of shares, right? Of rupees 100 each. So basically it would be 900, right? So this is the value given, right? So 74,000 and the 90,000. Now, service is to stay back with the company for 3 years, and the restriction to sell the shares after they are entitled is 2 years, right? Now, fair values given for equity price with the restriction on the sale of the year 2 shares is 115, and fair value at the grant date is 135, and at the end of year 2000, 2001, and 2002, these are the fair values given in the question, right? Pass the journal entries. So because we have just done a very similar question, would you like to try your hands on this quickly? I can wait for a couple of minutes so that you can do the calculation part at least, and then we will together discuss the journal entries. So you just need to come up with the expense part for the year 1 and for the year 2 and for the year 3. So for all the 3 years, you need to come up with the expense part. So just do quick rough calculations, right? Because we are doing the practice, so we don't need to be very conscious about the presentation at this stage. But certainly you need to come up with good presentation skills as well in the examination, right? For your answers to present.
Sir, number of cash settled shares is this amount or a number of shares, sir? That is 74,000.
Clear?
Yes.
So 74,000 and 90,000 are the number of shares, right? And these are the fair values given. Anybody ready with the calculation part?
Sir, equity component 3 lakh 60 and liability 99 lakh 90,000.
Okay. Others? I hope everybody is trying instead of waiting for the solution to discuss. Okay. So let's see how the calculations will happen in this case. So what is the fair value of the share with the restrictive clause? 115, right? So this is the fair value of the share, right? And what do you mean by the restrictive clause? That is the shares will not be sold for next 2 years after they are being credited into your demat account, right? So that is the restriction, right? And with factoring into that restriction, the share value given in the question is 115, right? Number of shares is 90,000. So the total fair value will be 90,000 into 115 rupees each share, right? So how much it is? 1 crore 3 lakhs 50,000 rupees, right? So that is the value of the shares. Now, fair value on the grant date is given in the question 135 and cash settled number of shares is 74,000. So fair value of the cash settlement option is 99 lakhs 90,000, right? So the fair value of the equity component will be 100 1 crore 3 lakh 50,000 minus 99 lakhs 90,000 3 lakh 60,000. This is the balancing figure, right? So this is called the value of the equity option, right? And this is the same which we were doing in our India's 109 as well. We used to arrive the value of the equity component by the deduction from the total amount of the debt component, right? So same approach, nothing different. Now, what would be the expense for the year one? So the year one expense would be, first of all, how many years the vesting period we have? So 3,60,000 is anyway fixed for all the 3 years. So I can divide it simply by 3. Yes, it gives me 1,20,000 expense for all the 3 years for the equity option fair value, right? And what is the debt option fair value? That will be fair valued on each year's fair value. So equity option fair value expense will always be fixed 1,20,000 and the liability or the debt or the cash settled option fair value will be fair valued at the end of the year fair value for each year. Number of shares will remain constant 74,000. So 138 into my 74,000 divided by 3. So 34 lakhs 4,000. Total of these two will be the total expense for the year one, 35 lakhs 24,000 for the year one. What would be the journal entry? Employee benefit expense account debit, that is the P&L debit, to share based payment reserve equity account, to share based payment liability account. Same journal entries. Why we are using the word reserve? Because equity share capital is not being issued at this point and we are simply creating the reserve. In case in the year 3, the other party asks for shares, we will debit the reserve and credit the equity share capital and the securities premium then and there. If the other party asks for the cash, we will simply transfer this reserve to the retained earnings at the end of the year 3, right? So this is how the year 1 entry will be constructed. Everybody is clear about the calculation as well as the debit credits.
Yes, sir.
For year 2, again, the equity component expense will be fixed because there is no movement in this, right? So this is always fixed on the day one divided by the vesting period, which is 3 years in this case, right? So 1,20,000. Now, share based payment liability account expense will be year 2 fair value into my 74,000 into my 2 by 3 minus the expense which we have already recognized in year 1, right? So 140 is given in the fair value for the year 2, 74,000 is the number of shares and 2 by 3 is the pro rata, that is 2 years divided by the total number of years 3. Because this is being calculated as cumulative fair value for the year 1 and 2 taken together minus the expense which we have already recorded in the P&L in the year 1. So that gives me the expense for the year 2, right? So the total of these two will be the employee benefit expense for the year 3, which will be again debited to the P&L and these two accounts will be credited. Narration will remain same. Recognition of the equity option and the cash settlement option, right? Everybody is clear on the year 2 calculation?
Yes, sir.
Year 3 calculation. Employee benefit expense again will be debited for the year 3, and again equity component expense is anyway fixed 1,20,000 for the year 3. The fair value is given 147, 74,000 is the number of shares. Pro rata is 3 by 3 minus year 1 expense minus year 2 expense. So the balancing figure comes to the year 3. Total of these two will go to the employee benefit expense account. Clear? So this is how we are going to record year 1, year 2 and year 3 expenses. Now, because the settlement will happen now, so if the settlement happens under the cash alternative, because the directors or the KMPs to whom the plan was assigned asking for the cash rather than shares. So what would be the settlement value? So settlement value will be year 3 value, because assuming the settlement is happening on the same date. So 147 into my 74,000. So 1,087,80,000, like 1 crore 8,78,000 would be the value of cash which will eventually be paid to them. And because it is being settled and paid in cash now, so we will debit the bank account or cash account as the case may be, right? So liability account debited to the bank account, settlement made in cash. And because the settlement has happened in cash, so equity shares are not going to be issued. So whatever the reserve which we had created over the period of 3 years, 1,20,000 each, accumulating to 3,60,000 for the 3 years, will be transferred to the retained earnings on the very same date, right? Assuming shares will not be issued anymore, right? If the KMPs come up and ask for the equity settlement, then what will happen? Then share-based payment liability account will be again debited, and to the share capital account and the securities premium account will be used now in place. Right now, how this will happen? So we will credit how many number of shares to them? What was the number under the equity option? Sorry, I forgot. 90,000, I guess. 90,000, right? And what was the face
90,000.
and what was the face value?
100.
So equity share capital will always be recorded at face value, yes or no? Right? So 90 lakhs will be the equity share capital account, by which equity share capital account will be credited by virtue of issue of 90,000 shares, right? And because the total liability we had is how much? 1 crore 8,78,000, right? So the balancing figure will go where? The securities premium account, because we have the fixed number of shares to offer 90,000, and by virtue of issuing 90,000 shares we are able to discharge the obligation of 1 crore 8 lakh by offering the shares worth rupees 90 lakhs. So what is the delta means the premium, that the shares are being issued at premium in that case, yes or no? So this is how the settlement will happen. Now this account, the share based payment reserve account, 3,60,000 rupees, which we had created over the period of 3 years, will be transferred to which account now? To the securities premium account, because the shares are being issued. So this is also being issued to credit to the securities premium account. Now the question comes whether you can credit it to the still to the retained earnings or the general reserve. Yes, you can do so as well. Any doubts on this? Anybody is having any questions, any doubts, or something is
Clear,
not
sir.
clear?
Clear, sir.
Clear? Okay. Let's move to question number 3. An entity which follows its financial year as per the calendar year. Okay. Financial year is as per the calendar year, grants 1,000 share appreciation rights, SARs, right? To each of the 40 management employees on the 1st of January 2005. right? So what would be the year end? 31st December, because the calendar year is the financial year, and SARs are always cash settled. So no point of getting confused with the equity settlement. SARs are always cash settled. SARs provide the employees the right to receive at the end of when the rights are exercised a cash equal to the appreciation in the shares price since the grant date. All of the rights vest on the 31st December 2006. So how much period is there for the vesting? What is the vesting period?
2 years.
2 years. And they can be exercised during 2007 and 2008. Management estimates that at the grant date fair value of each SAR is rupees 11. So grant date fair value is given and estimates that overall 10% of the employees will leave during the 2 year period. The fair value of the SARs at the end of the each year are shown as below. So for the year end 31st December 2005, 6, 7 and 8, 12, 8, 13 and 12 are the fair values given. 10% of the employees left at the end of the 2006. 31st December 2007, when the intrinsic value of the SAR is rupees 10, 6 employees exercise their options and the remaining 30 employees exercise their options at the end of the 2008, when the intrinsic value of the SAR is equivalent to rupees 12. How much expense and the liability is to be recognized at the end of the each year? Pass the journal entries along with. So you just need to come up with the expense amount for the year 1 and the year 2, as well as the journal entry for the year 1 and the year 2. And because this is a cash settled, so there is no point in getting confused how many shares will be issued, right? So shares will not be issued. Everything will be settled in cash. Question is clear to everybody? Facts you have noted down? So let's see how the calculation will happen in this case, first of all, because at the end of the day, calculation is the crucial part, right? So if the calculations are correct, we will get almost full marks. If the calculation is wrong, then we will not get any marks, right? The amount recognized as expense in each year and the liability at the end of the each year is as follows. For the 2001, the expense will be 2,16,000 and liability will also be 2,16,000. How this is calculated? 36 into my 1000 into my 12 into my 1 by 2. What is 36?
Number of employees
Correct.
after
So,
allowing for attention,
correct.
right?
So in the year 1, number of employees expected to continue is 36. So 36 is the number of employee. Each employee will get how many shares? 1000 shares. So 36 into my 1000, total 36,000 shares will be awarded under the plan. And because the fair value is given in the question on the grant date 12 rupees, so we will multiply the 12 rupees in order to come up with the fair value. And because the vesting period is 2 years, so 1 by 2 is the pro rata. Correct? So 2,16,000 will be the expense. So entry will be employee benefit expense account debit 2,16,000 to cash settled equity, cash settled share based payment plan liability account 2,16,000, right? Then in year 2, how the calculation will happen? Again, employees are expected to stay at 36 and 1000 is the number of options and 8 is the fair value and into the weight is 2 by 2, right? So 2 by 2 is being cancelled. That's why it is not mentioned, right? So 36,000 into my 8, right? And minus the expense which we have recorded in the year 1, right? So 2,88,000 will be the liability and 72,000 will be the expense. So at the end of the year 2, the total liability will stand for 2,88,000, right? And the expense for the year 2 is 288 minus 216, 72,000. I hope these calculations are to clear everybody,
Yes, sir.
right? Now in year 3, how many employees are there? As per the facts of the question, 6 left.
30 employees.
30 employees. So for the 30 employees, I will reinstate my liability. So 30 employees into my 1000 options into my 13 rupees is the fair value, right? So the liability stands at what? 3 lakh 90,000, right? And 1 lakh 62,000 additional liability will be incurred by virtue of increase in the fair value, right? So that will again become a liability. So that will again become the expense, right? Now let's try to settle the liability. So when we are settling the liability, what is the value at which the liability is being settled? At rupees 12, right? So 1 rupee is again coming back or coming down in terms of the fair value, right? So liability is recorded at 13 but settled at 12 because on the date of the settlement, liability fair value or the shares fair value is becoming 12 rupees each year, right? So how much benefit we will be deriving on this? So what would be the settlement value now? 30 employees, 1000 shares, 12 rupees. What would be the value? 3 lakh 60,000. And what is the liability now on the books? 3 lakh 90,000. So 30 rupees is the gain on the settlement. Yes or no? So difference between the liability of rupees 3 lakh 90,000 that is we have calculated here and the actual liability at rupees 12 is becoming 3 lakh 60,000. So in our books the liability stands at 390 but we eventually pay only 360 to discharge that. So 30,000 is the profit made on the settlement. Yes or no?
Yes, sir. Sir,
Right? So
I got stuck in the previous year, sir. That is third year. How we got that 1,02,000, sir?
1 lakh 2,000. Where is 1 lakh 2,000?
In that 1,62 increase in liability is 1,02,000 here. It is given.
162.
Yes, sir. That
So
60,000 is for settlement of that 6 employees who exercise the option,
hmm,
and that 1,02,000 how we got, sir? The difference amount.
okay. So expense comprises the increase in the liability. So first of all, are we aware that under the cash settlement we need to do the fair value at the end of the each year? Yes or no?
Yes,
Yes.
sir.
So
Yes,
if the fair value is risen from rupees 8 to 13, how much increase is this?
5 rupees.
So 5 rupees for the liability needs to be reinstated. Yes or no?
Yes, sir.
So 5 rupees liability is increasing, right? So how do we calculate this? So 6 into my 1000 into my 10. So 60,000 is the amount which was belonging to these 6 employees, right?
Yes, sir.
Who are exercising, who are paid those to who have exercised their SARs in the year 3. So they are paid at what rate?
10 rupees.
10 rupees. So they are fixed because they are discharged at 10. So their liability is assumed to be discharged at rupees 10 only. But for the remaining, the liability will be at what rate? 13,
Yes, sir.
right? So if you do the calculations that way, then you will be arriving at this number. Clear? 6 employees are discharged at rupees 10
Yes, sir.
and
That
remaining
I
30
got.
employees are reinstated at rupees 13,
Okay.
right?
Okay, we are increasing fair value from 8 to 13 for the remaining 30
Correct,
employees.
correct, correct, correct.
Yes,
Because liabilities are always reinstated at year-end fair values,
yes, sir.
right? Now, once the calculations are done, journal entries, so anyway we know and we remember what to debit, what to credit, right? So employee benefit expense will be debited for tool 16 to share-based payment liability account, being the fair value of the SARs recognized for year 2 72,000, for year 3 162,000, and share-based payment liability account debit to cash account 60,000 we have discharged, right? And in the fourth year and final year, we are gaining on the settlement. So 30,000 is the gain. So again, what will happen? Liability will be debited and the expense will be credited, right? So expense will be reduced and liability will be reduced. So opposite entry we will pass on here for realizing this gain, right? And finally, how much we are discharging? Share-based payment liability to cash, 3,60,000, right? So the journal entries are simple. The only catch in all these questions is to do the right calculations. And the thumb rule to in order to do the right calculation is always calculate a cumulative value and then deduct the expense which has already been recorded in the past years, right? So that's why always carry the weight as 1 by 2, then for the next year 2 by 2, right? Or if it is 1 by 3, then for next year is 2 by 3, and then for third year is 3 by 3, right? And then while calculating 2 by 3, so this gives you the cumulative value, yes or no? Yes, cumulative value minus the actual expense which we have recorded in the year 1, right? Similarly for the year 3, cumulative value minus the expense which is recorded in year 2 as well as in recorded year 1. So those needs to be deducted. So always try to calculate the cumulative values of the expenses, then deduct the expenses which are already recorded in the past years to come up with the expense to be recorded in the current year, right? If you follow this approach, instead of applying any shortcuts in the calculations, chances are high that you will end up doing the right calculations, right? Okay. Any doubts, any questions anybody has before we proceed on to the question number 4?
No, sir.
Okay. Question number 4. New Age Technology Limited has entered into the following share-based payment transactions, right? So there are multiple share-based payment transactions and not one, right? On 1st of April 2001, New Technology Limited decided to grant share options to its employees. The scheme was approved by the employees on which date? 30th June. News Technology Limited determined the fair value of the share options to be the fair value of the equity shares on 1st of April 2001, right? So this is the number 1. On 1st of April 2000, New Age Technology Limited entered into a contract to purchase an IT equipment from the Bombay Software Company Limited and agreed that the contract will be settled by issuing equity instruments of the New Age Technology Limited. New Age Technology Limited received the IT equipment on 30th of July. The share-based payment transaction was measured based on the fair value of the equity instruments as on 1st of April 2001. Okay. So we just need to note down somewhere these key dates. On 1st of April 2001, the newest technology decided to grant the share options to its employees. The scheme was approved by the employees on 30th June 2001. The issue of the share options was, however, subject to the same being approved by the shareholders in the general meeting, and the scheme was approved in general meeting held on 30th of September 2001. The fair value of the equity instruments for measuring the share-based payment transaction was taken on 30th September 2001. Identify the grant date and the measurement date in all the 3 cases. So, case 1, grant date, measurement date. Case 2, grant date, measurement date. Case 3, grant date, measurement date. Please try to draft this matrix or answers for yourself, and then we will see what is the right answer. As such, no
Sir, can you
calculations.
please, sir, can you please show the first and second?
Yes, yes, I'm showing up. Any luck with the answers?
Yes, sir. Done, sir.
Okay. So let's see. So first of all, we will revise what grant date means, what measurement date means, which we have discussed at the start. So grant date is the date at which the entity and the other party, including an employee, agree to a share-based payment arrangement. When the entity and the counterparty have a shared understanding of the terms and conditions of the arrangement. At the grant date, entity confers on the counterparty the right to cash or other assets or equity instruments of the entity, provided the vesting conditions, if any, are met. Right? If the agreement is subject to an approval process, for example, by shareholders, the grant date becomes the date when that approval is obtained. Right? So this is all we have discussed in the morning. Right? And what is the measurement date? Measurement date is the date at which the fair value of the equity instruments granted is measured for the purpose of this Ind-AS. Which Ind-AS? Ind-AS 102. For transactions with employees and other providing similar services, measurement date is the grant date. And for transactions with parties other than the employees, measurement date is the date when the goods or services are obtained, right? Or the counterparty, renders the services. Applying the above definitions in our scenarios, below are the grant date and measurement dates. For the scenario one, grant date is 30th June. Hence, measurement date will be 30th June. Yes or no?
Yes, sir.
Why? Because the transaction is happening with whom? The employees. And for employees, grant date always coincides with the measurement date. Correct?
Yes, sir.
For the transaction 2, grant date is 1st of April, but measurement date is 30th July. Why? Because
Goods are
entity
received on
is
that.
receiving the goods on which date? 30th July. So measurement of the fair value will happen on which date? 30th July. But the agreement took place on which date? 1st of April. So that become the grant date, but measurement will happen on 30th July. Because here the counterparty is not the employee. Here the counterparty is the third party other than employee supplying the goods to the company. Correct? In the third scenario, grant date is 30th September as well as the measurement date is 30th September. Why? Because in this case, what is happening? The grants are shares are being offered to whom? The third party or the employees? The employees. For employees, we know that grant date becomes the measurement date, right? Or to put it otherwise, grant date cannot be different from the measurement date, or measurement date cannot be different from the grant date in case of employees. So grant date and measurement date always remains same for the employees. That's the thumb rule. Now, what is the grant date in that case? So the grant date is the date on which the shares were agreed to offer to the employees, or the grant date is the date when, if any approval is necessary, that approval is obtained. So if there is any approval required from anybody, then once the approval is obtained, then only approval date becomes the grant date. And what is the approval from shareholders date in this case is the AGM on which the AGM was conducted and shareholders approval was taken. So 30th September becomes the grant date. And in case of employees, measurement date will always be the grant date. So 30th September will be the grant date and the measurement date. Any doubts? Yes, no.
Clear, sir.
Clear? Okay.
Yes.
Okay. So let's do this question. The following particulars in respect of the stock options granted by the company are available. Number of employees are 400. Option per employee is 60. So each employee will get 60 shares and number of employees are 400. Nominal value is 100 and exercise price is 125 rupees. per share, right? Shares offered were put into three groups. Group 1 was for 20% of the shares offered with the vesting period 1 year. Group 2 was 40% shares with the vesting period of 2 years. Group 3 was 40% shares for the vesting period of 3 years, right? So 20% shares 1 year, 40% shares 2 years, and 40% shares 3 years. So total number of shares are 100% covered, and vesting period for 20% shares is 1 year, 2 year, and 3 years, right? So this is how the plan is constructed. Now, fair value of the option per share on the date of the grant is rupees 10 for the group 1. For the group 2, it is 12.5, and for the group 3, it is 14 rupees, right? Now, position on the year 1, number of employees 40, number of employees to leave in the year 2, 36, number of employees to leave in the year 3 is 34. So basically it's not about to leave, it's about how many will be left. So 4 will be leaving, 36 will be remaining, 34 will be remaining. Exercise options, exercise employees exercising the options in the group 1 is 350, right? Similarly, for the position in the year 2 will be 35 number of employees and 30 number of employees in the second year. And for the position third year is employees is 20, right? 28, sorry. And employees exercising the option is equal to 295, right? So these are the options. Options not exercised immediately on vesting will be forfeited. So if the employees are getting the shares options, but they are not exercising, those will be forfeited. Compute the expense to recognize in each year to show the important accounts in the books of the company. So first of all, what we need to do? Again, the same thing, expense for the year 1, expense for the year 2, and expense for the year 3. And then what are the journal entries or the key ledger accounts the company will be maintaining to give effect to these plans? So that's the question. Now, if we have noted down all the facts of this question and understood the question, maybe we can start doing the calculations and discussing the solution. So if you want to note down some key aspects or facts of this question, you can do so before we actually move to the next page. All right. So total number of options per employee is how much? 60. That is given in the question, right? 60 is the number of options for each employee, right? Now, under the group 1, 12 options and vesting period is 1 year, right? How that is calculated or that is coming up? So if we go to this percentage wala line, group 1 was for 20% of the shares, right? So 60 options are given. So 60 into my 20%, how much? 12? Yes or no? 12
Yes,
options.
sir.
Then similarly for group 2, 60 into my 40%, 24 options. And then for group 3, 60 into my 24. Sorry, 40%, 24 options. So for group 1, 12 are the number of options. For group 2, 24 are the number of options. And for group 3, 24 are the number of options. For the group 1, vesting period is kitna? How much? 1 year. For group 2, it is 2 years. And for group 3, it is 3 years, right? So by doing this question, you will be able to learn anyway the key aspects around the calculations, and on the top of that, the presentation part, right? Because if we learn good presentations, then we incur lesser time in, answering the question in the examination, right? So if you do all the calculations in your paragraphs or in your working notes, then you end up, consuming a lot of time. doing that, right? So try to learn some quick presentations as well, which are self-explanatory of the calculations piece as well, right? Now, computation of the expense for all the 3 years. So group is equal to number of options. So group 1, 12 options, group 2, 24 options, group 3, 24 options. Now, because group 1 has 1 year, so we will create one column for group 1. Group 2 has 2 years vesting period, so year 1, year 2. And because group 3 has 3 years, so year 1, year 2, and year 3. Is that clear? Right? Now, employees at the end of the period, year 1. So for 400 minus 40. So how many employees will be continuing? 360. Clear? This is given in the question that 40 employees are leaving in the year 1, and the number will remain same for the year 1 for group 2, and the number will remain same for the year 3. Oh, sorry, year 1 group 3. Correct? 40 employees are leaving before the completion of the first year. So for the first year, to how many number of employees the option will vest? 360 employees. Is that clear?
Yes, sir.
For year 2, how many number of employees are leaving? Further, 35. So 360 minus 35. 325 will be the number of employees for year 2. Clear?
Yes,
And
sir.
further 28 employees are leaving in year 3. So for year 3, the number of employees are 297, right? So this is how we have calculated the number of employees to whom these options will actually vest. Clear? Now, how many are expected to leave in future? So 36 employees are further expected to leave, and 36 plus 34 are further expected to leave is equal to 70, right? So the number of final employees which will become eligible, so these are the already left and these are the further expected to be left. So further expected to be left will also be adjusted. So for the year 1 there is nothing which is expected to be left, but for year 2 there are 36, so final number of employees is 324, right, for the group 2. And for the group 3, 36 plus 34, 70. So 17 is the total number of employees which are expected to leave in future. So 360 minus 70, 290 will be the number of employees for group 3 options, right? And 30 for the year 2. So 295. So all this information is given in the question, right? So this is the number of employees which will finally be expected to have the options vested. Now, my question to you before I proceed further on this solution is, what is the basis of calculations? Are we assuming all the employees will continue with the company, or do we need to factor into those employees who are expected to leave from the company before the vesting? So what is your answer? So should we factor into those expected employees who will leave before the vesting? Yes or no?
Yes, sir. We need to factor that also.
Correct. So there are two categories. Number one, the employees who are already left. And number two, on the top of that, if any further are expected to leave. So both the employees needs to be factored. Already left anyway, because they are already left, so no vesting will happen to them anyway. But for the number expected to leave, will also be factored, right? Now, how many would be the number of options will which vest now? So the number of options we have already calculated. For the group 1 is 12, and for the group 2 it is 24, and for the group 3 is again 24, right? Which will be multiplied with these respective number of employees for these three groups, right? So total number of shares are calculated now. Clear? So these are the number of options or the number of shares which will eventually be vested to these employees, right? Once we get the number of shares or options, we need to simply multiply this with what? Fair value. So fair value is given in the questions, 10 rupees on the day one, right? On the grant date, 12.5 at the year end for the group two and 14 for the group three. It is already given in the question, right? So which will we will multiply and the total value will be calculated, right? Now we are done with the calculation piece for the total value of awards, right? Now, what is the cumulative value in this case? So cumulative value will be because group 1 is vesting over how many years? 1 year. So 43,200 into my 1 by 1. Correct? And group 2 is getting vested over how many years? 2 years. So 1 by 2 into my 2 by 2. And third is over 3 years, 1 by 3, 2 by 3, 3 by 3. Right? So these are the cumulative values. Right? Now, how much we have already recognized in the previous years for the group 1 0. So total expense to be recognized in the year 1 is 43,000 and which will be the full amount of the total expense incurred because the vesting period is 1 year only, right? So there wouldn't be any further expense for the year 2 and year 3 for the group 1 options. For the group 2 options, in the first year, the expense will be 48,600 and in the next year it will be 97,500 minus the previously recognized, that is 48,600. So 48,900, right? And similarly for the group 3, in the year 1, 1 by 3, this will be recognized. In the year 2, 2 by 3 minus previously recognized, so balancing figure. And in the third year, 3 by 3 minus the previous amounts recognized. This much, this one, and this one, right? So the balancing figure. So this would be the expenses which will be ultimately recorded in the P&L, right? Yes or no? Are we clear on this?
Yes, sir.
Now, employees not exercising the options are how many given in the question? So 6 employees for the group 2, 2 employees for the group 3 and 10 employees for the group 1. So 10 employees not exercising for group 1, 6 employees for not exercising for group 2 and 2 employees not exercising for group 3. So what would be the expense for the year 1, year 2 and year 3? Total expense. 43,200 for the group 1, 48,600 for the group 2, and 32,480. So 1,24,000. How this total is arrived? Everybody understood?
Yes, sir.
So this one plus this one plus this one, correct? And for year 2, this one plus this one. And for year 3, anyway, only one item we have, right? So this is the year 1 expense, this is the year 2 expense, and this is the year 3 expense, right? Now, because instead of journal entries, what is being asked in the question to present the ledger accounts, right? So anyway, whatever the question asks, we will do that. We are professional accountants and we know how the ledger accounts are presented. Employees benefit expense account, year 1. Buy profit and loss account, year 1 expense. What is the year 1 expense? 124. 2 share based payment reserve, 124, 280, right? So 124, 280 would be the total for the year 1 because one single entry expense will be recorded. In case from the presentation perspective, you want to present the group wise expense, right? So you can do so as well. Instead of, compiling the whole entry, you can present share based payment, group 1 reserve account, share based payment, group 2 reserve account, share based payment, group 3 reserve account. That is also can be done from presentation perspective, right? Then for year 2, what is the expense? 82,500. And for the year 3, 33,712. Correct? So this is how the employee benefit expense account will look like. How the share-based payment reserve account will look like. So first of all, year one expense is coming through 124,280 by employees benefit expense account, right? Now, in year one, how many options are getting exercised out of the total options, or basically how many are not getting exercised? So 10. So 360 were the total, 350 are exercising, right? Employees, and 12 options into my 10 rupees is the settlement value, right? So what we will do, we will discharge 5,25,000 rupees, right, to discharge this obligation, right? And to share capital account 350 employees into my 12 options into my 100 shares, 4,20,000. So this 4,20,000 is calculated how? Total number of employees 350, 12 is the number of options for each employee, and 100 is the face value. So share capital account is being credited with this much amount, and remaining amount will go to securities premium account, right? And whatever is the balance is the carried forward, right? So this is how the year one presentation for the share based payment reserve account will look like. Similarly, for year two, balance brought forward from the previous year, then second year expense, and then second year settlement. Second year settlement is happening to how many number of employees? 325 is the total. 6 are not exercising. So 6 we minus 319, right? So 325 uh, minus 319 employees into my 24 options into my 12.5. So 6 employees are the only employees to whom uh, the shares are not being exercised or issued, right? So how the calculation will happen? 319 employees are exercising 24 options each at rupees 100. So shares will be issued to how many number of employees? So total were 325, 6 are not exercising, right? So for the remaining 319 employees, we are issuing the shares, and each employee is getting how many shares? 24 shares, right? At the 100 rupees face value, share capital account will be used, right? Equity share capital account, and remaining will go to the securities premium, right? Clear? Any questions on this in year two? Yes, no?
No, sir.
Okay. In year three, what will eventually happen? How many employees are exercising? 2 employees are not exercising. Total is the 297, and 295 are the number of employees who will eventually get, right? So 295 employees into my 24 shares into my 100 rupees equity share capital account, right? And remaining 295 employees into my 24 shares into my 39 the securities premium. So this 39 will go to the security premium, the balancing, right, from the value. So this is how the equity share capital and securities premium account will be presented. And how much is the employee benefit expense account for the third year? 33,712, that we have already calculated in the table above, right? So this is how this will be arrived here. And 295 employees are getting discharged into my 24 options at rupees 125 each. So 885 is the amount, right, against which we are discharging this obligation by issuing the shares, right? So this is how the year 3 calculation will be presented in the ledger. Now, what are the working notes which we need to give for these calculations? So exercise price received per share is how much? 125 rupees, that is given in the question. Value of the service received per share being the fair value of the options is rupees 10 rupees, 12.5 rupees, and 14 rupees. This is again given in the question, right? Total consideration received per share is how much? 135 rupees, 137.5 rupees, 139 rupees. Total of these two. And nominal value per share, that is the face value of one share, is how much given in the question: 100, 100, and 100. So what is the security premium? 35, 37.5, and 39.5, which is being used here. So 39 for the third year, and 37.5 for the second year, and 35 for the year 3. So this is how the securities premium balancing figure is calculated by deduction of rupees 100 from the total value of the consideration per share. Any questions on this? So because these questions requires lot of careful calculations and the focus. So I urge everybody to practice these questions on their own first, then compare the answer with the solution so that you get to know where you are doing the mistakes. So if you do the revision simply by looking at the solutions throughout your practice, then it will not serve the purpose. So you need to try these questions before, without looking at the solutions, and also setting up the clock watch, right? So that you don't end up doing all these calculations and the solution of the questions in 1 hour or more than 1 hour, right? So decide the dedicated time, maybe 15 minutes for this question, and then try to do this along with the presentation and the right calculations. And if you are doing the mistakes, then you will certainly realize what error you have done, right? So I suggest to practice on your own rather than simply looking at the solutions given in the textbooks. Then only you will be able to master this. Okay. So the next question is, Entity A runs a copper mining business. Entity A has a year end 31st March. Dividends declared on the shares accrued to employees during the 3-year period. If the condition is met, the employee will receive the shares together with the dividends and that have been declared on those shares during the 3 years up to the 31st March 2003. The entity estimates 1st April 2010 or 1st April 2000, its shares are valued at rupees 10 each. The grant date fair value of the share is rupees 10, right? So grant date fair value is rupees 10 given in the question. Entity A prepares the financial statements for the year ended 31st March year end. On 1st of April, it estimates 800 shares will vest. At the end of the year 1, it has revised this estimate to 780, and at the end of the year 2, it further revised to 750, right? So in year 1, entity says 780 shares will vest, or in year 2, it will be 750. On 31st March 2003, 750 shares will vest based on the number of employees still employed on that date. So 750 actually vested on 31st March 2003. Now, on 1st of April 2000, as part of the long-term incentive, Entity A provisionally awards its sales employees 1000 entities A's shares receivable on 31st March 2003. Explain the accounting treatment for the above share-based payment awards based on the satisfaction of the condition that the sales employees must remain in employment until 31st March 2003. The requirement to remain in to remain in employment is a service condition and would not be reflected in the fair values of the share awards. So what is happening over here? So entity is saying that if the employees stays with the firm for the next how many years? Until the 31st March 2003, from the 1st of April 2000, so 3 years, right? Then they will be awarded the shares. And on the date of the award, 800 shares will vest. That was the assumption. While the assumption was to vest 780 shares at the end and the 750 at the end of the year 2. And at the end of the year 3, 750 actually vested, right? Now you need to come up with the calculations. So try to calculate the expense amount for the year 1, year 2, year 3. So that's the most crucial aspect about this standard. So if we are able to do the calculations right, then anyway we will figure it out what the entries we need to post, right? If the expense is wrong, everything is wrong. And if everything is wrong, we will get 0 marks. So what is the expense for year 1, year 2, and year 3? Are you trying to calculate?
Yes, sir.
Okay. What is the amounts? Hmm.
2,600. Year 1.
Okay.
Year 2, 2,400. And year 3, 2,500.
Okay. I hope everybody is calculating. I'm getting the answers mostly from one candidate. Others? Right. So answer is correct for you. You said 2,600, 2,400, and 2,500 for the years 1, 2, and 3, right? What would be the entry? Entry anyway we know. We have learned it by heart now, right? If anybody asks us what is the journal entry for the recording of the share-based payment expense under India's 102 at 2 a.m., then we will be able to answer this, right? Employee benefit expense account debit to share-based payment reserve account, right? So this entry we have learned, right? Because we have passed this many times, right? And supported by the right amount of the calculations will fetch you the full marks, right? Now, how this calculation is happening, that's we need to understand quickly. So, how many shares are expected to be vested in the year one? 780. How many shares into my 10 rupees is the grant value, right? Fair value of each share. Into my 1 by 3 is the pro rata for the year one, right? So 780 into my 10 into my 1 by 3. For the year two, it will be 750 is the revised estimate of the number of shares which will eventually be vested into my 10 rupees, again the grant date fair value, into my 2 by 3 the pro rata minus the year one expense, right? And for year 3, finally 750 will be vested at 10 rupees grant value, grant date fair value, less amounts which have been recognized in the years 1 and in the year 2, right? So this is how the cumulative expense minus the expense already recognized approach fetches us the right answer, right? So this question was actually very simple. It required simple calculations, right? And simply 3 journal entries which we need to post for each of these 3 years. So let's proceed on to the question number 7. But before we proceed, anybody and is having any doubts on this? Clear? Perfect. Fashion India Limited entered into an agreement with RFD Limited on 10th of August 2002 for purchasing a machinery. So one company is purchasing a machinery from the another company. The agreement has a clause that Fashion India Limited will have to settle the consideration of the machinery purchased by issuing its equity shares, right? So how the consideration will be discharged? By issuing the equity shares. Fashion India Limited agreed to the clause and the order was confirmed. Machinery was supplied by invoice dated 25th of October 2002 and delivered on 1st of November 2002. The agreed purchase consideration was 150 lakhs and the fair value of the machinery supplied was estimated to be 160 lakhs. As agreed, FIL Fashion India Limited issued 1 lakh equity shares of the face value of rupees 100 each to RFD Limited as per India's 102 share-based payment. What would be the price and the date for recording the machinery purchase from RFD Limited? So you need to come up with the value, that is at what value you will be recording the machinery and on which date. So just try to think through on this, whatever we have learned or discussed in the beginning of the session when I was talking about the measurement date and uh, the grant date and if the agreement is with the third parties, then what would be the measurement date, right? So basis on those things which we have discussed, try to think through and come up with the answer on this.
Sir, measurement date is date on which machinery is received.
Mm-hmm.
That is 1st November. And
Okay.
amount is fair value of the machinery received.
So what would be that?
160 lakhs.
So you are saying 160 lakhs would be the amount at which the machinery will be recorded and on 1st of November.
Yes, sir.
Okay. Others?
Same,
No?
sir. Same.
Answers from others?
So same like purchase consideration of the machinery will be 160 lakhs
Mm-hmm.
and
1st of November.
rest have to be I think will be paid in cash rest of the amount. 150 lakhs ka to we had the shares which we need to give them and the purchase consideration for the machine is 160 lakhs so less like 10 lakhs will have to pay.
Okay. Others? Okay. So entry would be machinery account debit or the property plant and equipment account debit 160 lakhs, right? Because the fair value of machinery is 160 lakhs. Two, equity share capital and two securities premium, right? 100 lakhs and 60 lakhs, right? So this would be the entry. Now, on which date this entry will be recorded? 1st of November? Because unless and until the machinery is received, can we capitalize the machinery in our books? No. Before the receipt of the machinery, how we can do the capitalization, right? Because capitalization happens only when machinery is available for use and machinery becomes available for use only when it is received. Even if the invoice is received of a prior date and invoice is already received in advance, can we record the invoice without receiving the actual fixed assets? No, right? So as per para 7 as well of the Ind AS 102, the control is assumed to be transferred on the date of the machinery is delivered, right? Which is 1st of November. Therefore, this will be the date of recognizing the machinery in the books of accounts and the entry will be value of the machinery is how much? 160 lakhs. So machinery will be capitalized at 160 lakhs. So that anyway, this is the accounting which is governed by which standard? Ind AS 16, property, plant and equipment, right? At what value the machinery is capitalized? The value to which the machinery carries, right? So machinery's value is 160 lakhs. Now we are discharging these obligations by issuing equity shares. So because of that, standard India's 102 comes into play. And here the standard says, so let's read some theoretical part of the standard first. As per para 10 of India's 102, for equity settled share based payment transactions, the entity shall measure. Shall means mandatory, right? No option or no choice we have. Shall measure the goods or services received and the corresponding increase in the equity directly at the fair value of the goods or services received. So what the goods or services we are receiving? Machinery. And what is the fair value of the machinery given in the question? 160 lakhs. Unless that fair value cannot be estimated reliably. So if we challenge that machinery's fair value, we do not know. That is what is the value of the machinery, we do not know. Then in that case, what company can do? What is the number of shares which we are discharging against purchase of this machinery as a consideration? Those shares fair value can be used for recording of this transaction, right? So standard says if the entity cannot estimate reliably the fair value of the goods or services received, the entity shall measure the fair value and the corresponding increase in equity indirectly by reference to the fair value of the equity instruments granted, right? So first choice, what is the first choice? Fair value of goods, yes or no? If we say that is not measurable, then second choice is fair value of shares given. Correct? Yes or no? Right?
Yes, sir.
So this is how India's 10 comes into play and asks us to record the transaction at the fair value of the shares if the fair value of the goods or services, which in our case is the machinery, is not available or not determinable, right? Because in the question it is given, so we will record the entry at 160 lakhs. And the date. Date would be the date on which the agreement took place, or the date would be the date on which the invoice was generated by the vendor, or the date would be the date on which the machinery is actually received by us. So standard clearly says when the goods or services are received. So the date of the receipt of the machinery will be considered for accounting of this journal entry as per India's 102. Now my question to all of you is, because we are talking about the fair value since morning, right? So what do you think? How the fair value will be determined for the purpose of this standard? Whether we will apply India's 113 fair value measurement, or we will not apply India's 113 fair value measurement for determining the fair value under the India's 102. What do you think? Hanji.
We need to consider as per India's 113, sir.
Okay. Others? 113 will be applicable for the purpose of measurement of fair values under India's 102 or not? That's the question. So, if I say you that 113 will not be applicable for the purpose of determination of fair values under the India's 102 for the shares, then will you be surprised? So, what is the fundamentals or the framework of the accounting says? So accounting framework says whenever there is a specific standard to talk about a particular matter, then that specific standard prevails over the general. Yes or no?
Yes, sir.
Right? Now, because India's 102 has its own definition of the fair value, right? So 102 has defined the fair value within the 102, right? So if India's 102 is the specific standard, which is telling you what the fair value means, right? For the purpose of India's 102, then you will listen to 102 or you will go to somewhere else.
102, sir.
102. So because 102 is the standard which defines the fair value for the purpose of 102 itself, then we will not vendor here and there, right? So we will simply listen to 102, right? And because 102 is giving the fair value definition, so we will not apply Ind AS 113 for the purpose of determining the fair value under the Ind AS 102 for the shares, right? But what does it mean? Whether all the shares for any transaction will be measured under Ind AS 102? No. So if the transaction is covered under Ind AS 102, then the fair value will be measured under Ind AS 102 itself. If the transaction is not covered under Ind AS 102, then the fair value will be measured under which standard? Ind AS 113. So for all the other fair values determination for all those transactions which are not covered under Ind AS 102, fair value will be determined under Ind AS 113 only. And if the transaction is the share based payment transaction which is covered within the Ind AS 102, then the fair value will not be determined under Ind AS 113. Is that clear?
Yes, sir. Clear, sir.
Now, one more question I have. In the recent question, where we said that fair value of the machinery is 160 lakh, right? And the we have used that, right? Fair value. What do you think? Under which standard that 160 lakh would have been arrived? 102 or 113?
102, sir.
No. So that's the catch. So catch is Ind AS 102 says, boss, when you are computing, okay, note down this somewhere on your writing pads because you will otherwise forget. So 102 says, when the requirement is to determine the fair value of the shares or the options or the SARs, right? And for the transactions covered within the scope of 102, then the 102 will be the fair value determination standard for those shares. If the transaction is not covered within the 102, then 113 will come into play. But fair value determination of 102 is restricted to the fair value of the shares, options, or the SARs, right? Not to other items. Now, because in this case, machinery's fair value is being computed. So, machinery's fair value will not be computed under 102. That anyway would have been computed under 113 only because if the machinery is fair valued, then fair value under Ind AS 16 is computed under which standard? Ind AS 113. So for machinery fair value is anyway computed under Ind AS 113, right? But if the machinery fair value is not available and we need to come up with the fair value of the shares we are offering to discharge this obligation towards the vendor, then that fair value will be computed under 102. Is that clear?
Yes, sir.
So
Yes, sir.
what's the final answer? So final answer is if shares or options or SARs which are being fair valued for the transactions covered under Ind AS 102, then the fair value will be determined under 102, otherwise not. Clear? I hope everybody is clear on this.
Yes, sir.
Yes, sir.
Okay. So that was it from my side. In case anybody wants to ask any question, I am opening the forum for all of you. Okay. So no questions. So I hope you enjoyed the session. It was informative for all of you, and I wish you all the very best for your examinations. See you as a chartered accountant soon. With that note, I am winding up.
Thank you, sir.
Thank you. Have a good day. Bye.
Thank you, sir.
Ashokji, session is over. Thank you.